And those inflation concerns pushed higher as the Federal Reserve raised interest rates again just days ago. From the housing market to credit cards and even student loans, everything is getting more expensive. Joining us now is the Senior Vice President and Senior Policy Director for the Committee for a Responsible Federal Budget, Marc Goldwein. Thanks for being here. So put in perspective for us these recent interest rate hikes. How do they compare to the past, for example, in the 80s?
Well, we're nowhere near where we were in the 80s, but this is the largest interest rate hike we've had since then. We just went up 3/4 of a point after going up half a point after going up 1/4 of a point. So interest rates, which were basically at zero, are now almost 2%. Soon enough, they're going to be 3, 4, maybe even 5%.
So what does it mean for people trying to buy homes right now? Let's start there in the real estate market. Do you see it impacting the market?
Oh, for sure. Homes is where this has had the most immediate effect. If you bought a home about a year ago, you could have gotten a 3% interest rate. Now it's more like 6.5%. So if you're buying a $500,000 home, that's $1,000 a month more in mortgage payments just from those higher interest rates. And that's really cooling down the excitement for people buying homes and making it a lot harder for them to be sold as well.
And one thing we all likely have, right, even if we don't have student loans or mortgages, we all have credit card debt, I think. Do we stop using credit cards as much? Do we race to pay off the balance? What are we supposed to do when it comes to credit cards?
Yeah, look, if you can, you should try to avoid having too much credit card debt that lasts more than a month anyway, because credit card interest rates, even when they're low, are very high. But now they're going to be even higher. So to the extent you can get those credit cards paid off, so again, you only have that 1 month's balance, you're in a much better position.
And what about student loans?
So student loans are still in moratorium. Unless you have a private loan, nobody's right now paying back student loans at all. But when new student loans are issued, those rates are going to start to be going up. They went up a little bit this year. They're probably going to go up a lot next year.
So how else really, though, are we supposed to slow down inflation? I mean, which is worse, high interest rates or high inflation?
Well, the high interest rates are to combat high inflation. And the high inflation, I think, is definitely worse if it's runaway inflation. So we do need to get this under control. And the best way to get inflation under control at this point is we all need to be spending a little bit less. If you have opportunities to work from home, I heard some of your guests doing more carpooling. That kind of thing can help. It's good for your own pocketbook, but it actually can slow down the exact inflation that's the problem in the first place.
But short of people slowing down their spending habits in this flurry post-pandemic, is there any other option besides raising the interest rate?
The federal government can do things besides raise interest rate, like lower healthcare costs, try to get oil production back up, clear supply chains. That stuff can help a little bit. Deficit reduction would be good. But at the end of the day, interest rates are going to have to go up. If we don't stop spending voluntarily, the Federal Reserve is basically going to force us. That's what the higher interest rates do. They force us to buy less homes. They make us poorer if you have investments. And so they get us to spend less. And that's really the only way to get inflation under control.
And we've been in this workers' job market for the past couple of years now. Should we expect that to change?
I don't think the current rate of employment is sustainable. We may be able to hold it, but we're not going to keep adding jobs at that pace. The Federal Reserve thinks the unemployment rate is going to go from 3.5% up to 4%. That 4% would still be very good by historic standards, so we should hope for that. But I think we're kind of at the best we're going to be for a while now, unfortunately.
All right. Well, thank you for the bad news. Marc Goldwein, thank you for joining us tonight.
Thank you for watching. Go to newsnationnow.com to find News Nation on your television provider. And don't forget to click the red subscribe button below to get more of News Nation's fact-driven, unbiased coverage.